Welcome to the deep dive. We're here to sort of untangle the complex world of money and markets.
That's right. It's a big topic, and today we're really diving into how it all works, from companies getting started to how we as individuals can invest.
Exactly. We want to give you a solid grasp of the mechanics, the plumbing behind the financial headlines without getting bogged down in jargon, a clearer picture of the whole ecosystem.
Yeah, think of it as building a framework so you can understand how capital moves, how risk is handled, and just, well, what all these different investment options actually are.
Okay, great. So fundamental question. Businesses need money, cash to get going, to grow. Where does that initial funding typically come from?
Well, often the very, very first money comes from, close circles,
Mm,
the founders themselves, maybe friends, family,
yeah.
people who believe early on.
Angel investors, right?
Angel investors, exactly. They provide that crucial early seed money. It's often in exchange for a piece of the company, equity, high risk, definitely, but based on belief in the idea.
Makes sense. Very personal at that stage. But what about when a company proves itself a bit, shows real promise, and needs like a serious chunk of change to scale up?
Uh-huh. That's often where venture capital firms or VCs come in. These are specialized firms pooling money, usually from big institutions or wealthy individuals.
And they're looking for.
High growth potential. They invest larger amounts in private companies they think could really take off. But it's important to remember, the failure rate for VC-backed companies is pretty high too. It's a high-risk, high-reward game.
Right, right. So the stakes get higher. But even VC funding isn't always enough for, say, a really established company needing massive capital, is it?
No, definitely not. For the really big funding needs, companies often turn to the public capital markets.
Okay, so selling shares to the public, the IPO?
The IPO, yeah, the initial public offering,
Yeah.
that's one major route. It raises a lot of money, but also means becoming a public company with all the regulations and scrutiny that involves.
And the other main way.
Issuing bonds, essentially borrowing money directly from investors. They promise to pay that money back, the principal, plus regular interest payments over time. Often, a solid company can get better terms this way than, say, a bank loan.
Okay, so getting access to these huge pools of money sounds great, but you mentioned trade-offs. What are the downsides for companies going public or taking on debt like that?
So absolutely. When you sell stock, you're giving up some ownership. You now have shareholders, potentially thousands of them, who have rights and opinions. It can create pressure for short-term results.
And with bonds?
With bonds, it's debt, a legal obligation. You have to make those interest payments and repay the principal on schedule. That can really restrict a company's financial flexibility, especially if times get tough.
And navigating all this. IPOs, bond issues. It's complicated. I assume there are specialists involved. Investment banks.
Yes, investment banks are key players here. They act as intermediaries, advisors. They help companies figure out the best way to raise capital public offerings or maybe private placements.
Private placements, what's that?
That's selling securities directly to a smaller, select group of sophisticated investors, wealthy individuals, institutions. It often involves less red tape than a full public offering. Investment banks underwrite these deals too, meaning they basically guarantee the sale.
Got it. So we see how money flows into companies, but with all this activity, you need rules, regulation. Why is that so critical in these markets?
Regulation is really about maintaining trust and fairness. You need a level playing field, efficiency, and crucially, investor confidence. Without that confidence, people won't invest, and capital won't flow where it's needed for economic growth.
Mm.
So regulation tries to foster that safe, reliable environment.
And who are the main rule makers? Who's the referee?
Well, you've got two main types. First, government regulators. At the federal level in the U.S., the big one for stocks and bonds is the Securities and Exchange Commission, the SEC.
Right, the SEC. Their main focus is.
Disclosure, primarily, making sure companies tell investors the important stuff, the good and the bad, so people can make informed decisions. They enforce the securities laws.
And there's another one, the CFTC.
Yes, the Commodity Futures Trading Commission. They oversee different markets, futures, options on futures, swaps. Their goal is similar: prevent fraud, manipulation, keep those markets fair and sound.
Okay, government regulators. And the second type you mentioned.
Self-regulatory organizations, or SROs. These are industry bodies that get authority from the government regulators to police their own members.
Like stock exchanges.
Exactly, like the New York Stock Exchange, or FINRA, the Financial Industry Regulatory Authority, which oversees brokerage firms and brokers. They set industry standards, conduct surveillance, enforce rules, working alongside the SEC and CFTC.
So it's a layered system. Okay, let's switch gears now to us, the investors. How do we actually participate? Let's start with stocks. If I buy a share of, say, Apple, what do I actually own?
You own a tiny piece of Apple. A share of common stock represents fractional ownership in the corporation.
And what do I get for that?
Potentially two things. One, dividends, if the company decides to distribute some of its profits to shareholders. Two, the hope that the stock price itself will go up, so you can sell it for more than you paid.
Mm.
But crucially, the price can also go down. There's risk.
Right. And I've heard of preferred stock too. How's that different?
Preferred stock is sort of a hybrid. Preferred shareholders usually get paid dividends before common shareholders, and if the company dissolves, they have a higher claim on assets.
Sounds better.
Well, the trade-off is usually less potential for big price increases, and preferred stock typically doesn't come with voting rights like common stock does. It's generally less volatile.
Okay. Now, companies. We hear public and private. What's the key difference, and how does a private company become public?
A private company's shares aren't traded openly. Ownership is restricted. A public company has sold shares to the public, usually through that IPO process we mentioned.
The IPO again?
Yeah. The company works with investment banks, registers with the SEC, and sells shares for the first time on an exchange. Then anyone can buy or sell them, though some companies are trying other ways now, like direct public offerings, DPOs, trying to bypass some of the traditional steps.
Interesting. So once it is public, where does the trading happen? NYSE, NASDAQ?
Yeah.
Those are the big names, yeah.
Those are the giants in the U.S., definitely. The New York Stock Exchange, historically known for its trading floor, though now mostly electronic. NASDAQ, which was always electronic. And others have emerged too, like BATS, increasing competition. They're all registered exchanges, operating under SEC oversight and their own rules.
But trading doesn't only happen on those main exchanges anymore, does it? What about ECNs and dark pools? Sounds mysterious.
Yeah. They're alternative trading venues.
Yeah.
ECNs, electronic communications networks, basically match buyers and sellers directly, often institutions. They can be faster, sometimes cheaper.
And dark pools?
Dark pools are private platforms. The key thing is they don't display the orders publicly before a trade happens. Large institutions use them to trade big blocks of stock without showing their hand and potentially moving the price against them. But they've also drawn criticism about transparency.
Right. When you look up a stock price, you always see two numbers, a bid and an ask. What's that about?
The bid is the highest price someone is currently willing to pay to buy the stock. The ask is the lowest price someone is willing to accept to sell it.
And the difference is the bud.
The spread. That's the gap between the bid and ask. Market makers, the firms that facilitate trading and provide liquidity, essentially profit from that spread. A smaller spread usually means the stock is easier to trade.
Makes sense. So stock prices wiggle around constantly. What makes them go up or down?
Oh, lots of things. The overall market mood, definitely. Economic news, industry trends. But specifically for a company, its performance is huge, earnings, revenue growth, profits.
So good results, price goes up.
Usually. But it's also about expectations. What do investors think will happen in the future? If everyone expects amazing things, the price might get bid up really high, maybe even become overvalued. If sentiment turns negative, it can fall, maybe become undervalued. It's complex.
Okay. As investors, we hear about strategies. Buy and hold is a common one. What's the philosophy there?
Buy and hold is basically a long-term strategy. You pick investments you believe in, maybe stocks of solid companies, and you hold on to them through the market's ups and downs. The idea is that over long periods, the market generally trends upward.
And you might reinvest dividends.
Exactly. Reinvesting dividends buys you more shares, which can then earn more dividends. It's compounding. The total return you get is the price change plus any dividends you received.
The market itself goes through phases, right? Bull markets, bear markets, what are those?
A bull market is a sustained period where prices are generally rising. Lots of optimism, usually a decent economy. A bear market is the opposite, a significant prolonged decline, often defined as 20% or more down from a peak. Pessimism, maybe an economic slowdown.
And sometimes just a dip.
Yeah, a correction is usually seen as a shorter-term drop, maybe 10–20%. Bear markets tend to be shorter than bull markets historically, but they can happen fast.
When trying to pick stocks, analysts seem to use different methods. Fundamental versus technical analysis.
Right. Fundamental analysis digs into the company itself, its financials, management quality, competitive position, the industry, trying to figure out its intrinsic value. Is the stock cheap or expensive based on the underlying business?
And technical.
Technical analysis ignores all that. It just looks at charts, price patterns, trading volumes, statistical indicators, trying to predict future price moves based on past market behavior. Many investors use a bit of both.
How do we measure the riskiness of price swings of a stock? Volatility.
Volatility, yeah. It measures how much a stock's price tends to fluctuate.
Mm.
Standard deviation is a common statistical way to measure it. High volatility means bigger, faster price swings, more potential reward, but also more risk. Low volatility is steadier.
Okay, so say you've done your homework. You want to buy a stock. How does that actually happen? Brokers, order types.
First, you need a brokerage account. You can go full service where they give advice costs more, or discount, more self-directed, cheaper commissions, or purely online platforms.
And when you place the trade?
You need to specify an order type. A market order just says buy or sell it now at the best available price. Quick, but the price might shift slightly. A limit order lets you set your price, buy only if it hits $50 or less, or sell only if it's $55 or more. Gives you price control, but it might not execute if the price doesn't reach your limit.
Any others?
Stop orders are often used for risk management. Like, if the price drops to 48 days, sell my shares, turning into a market order then to limit losses. And day orders expire at the end of the trading day if not filled.
What about more advanced stuff? Buying on margin, selling short. Sounds risky.
They absolutely are riskier. Buying on margin means borrowing money from your broker to buy more stock than you could with just your own cash. It magnifies potential gains, but also magnifies losses. Plus, you pay interest on the loan.
And selling short.
That's betting a stock price will fall. You borrow shares from your broker, sell them on the market. Then you hope the price drops so you can buy the shares back cheaper, return them to the lender, and pocket the difference.
But if the price goes up?
You could lose a lot. Theoretically, losses are unlimited because a stock price can keep rising. Definitely not for beginners.
Wow. Okay, once a trade happens, there's a back-end process, right? Clearance and settlement.
Yeah, it's not instantaneous behind the scenes. Clearance is confirming the trade details, who bought what at what price. Settlement is the actual exchange, the shares officially change hands, and the money moves. It's mostly automated now by clearinghouses like the NSCC and DTC, making sure everything matches up smoothly.
Right, essential plumbing.
Hmm.
Okay, let's shift from stocks to another huge area, bonds. What's the basic idea of a bond?
A bond is basically an IOU. You're lending money to an issuer, could be a company, a city, the federal government.
And in return?
They promise to pay you back the original amount, the face value or par value, on a specific future date, the maturity date. And along the way, they usually make regular fixed interest payments, called coupon payments.
Fixed payments, so that's why they're called fixed income securities.
Exactly. It's a different risk-return profile than stocks, generally seen as safer, but usually with lower potential returns.
And lots of different issuers, you said.
Oh yeah. Corporations issue corporate bonds. State and local governments issue municipal bonds, or munis, often to fund things like schools or roads. And the U.S. Treasury issues treasury bills, short-term, notes, medium-term, and bonds, long-term. They're considered very safe because they're backed by the government.
Are there other treasury types?
There are TIPS, Treasury inflation-protected securities, where the principal value adjusts with inflation, protecting your purchasing power, and FRNs, floating rate notes, where the interest payment adjusts periodically based on current interest rates.
So even though the coupon payment is fixed on most bonds, you mentioned earlier that bond prices can change in the market after they're issued. Why?
The biggest reason is changes in overall interest rates. Think about it. If you own a bond paying 3%, and new bonds start being issued that pay 4% because interest rates have gone up.
Your 3% bond looks less attractive.
Exactly. So its price will likely fall below its face value. It trades at a discount. Conversely, if interest rates fall to, say, 2%, your 3% bond looks great, and its price might rise above face value, trading at a premium. The issuer's credit quality also matters, of course.
Okay. So how do investors measure the return on a bond, considering these price changes? You mentioned yield.
There are a few yield measures. Coupon yield is just the annual interest divided by the face value. Current yield is the annual interest divided by the current market price.
But the most complete one?
That's yield to maturity, or YTM. It accounts for all the future coupon payments, plus the difference between the price you paid and the face value you'll get back at maturity. It gives you the total expected annual return if you hold the bond until it matures.
Bond ratings seem really important. S&P, Moody's, what do those ratings tell us?
They're assessing the issuer's creditworthiness. Basically, how likely are they to actually make all those promised payments? They assign letter grades like AAA, AA, A, BBB, BB, etc. Higher ratings mean lower perceived risk of default.
And lower-rated bonds.
They usually have to offer higher yields to compensate investors for taking on more risk. These are sometimes called high yield or junk bonds. The ratings are a key piece of information for bond investors.
And like stocks, can you buy and sell bonds after they're issued?
Yes, there's a huge secondary market for bonds. But unlike stocks, most bond trading happens over the counter, or OTC. It's more of a network of dealers trading directly or electronically, not a centralized exchange like the NYSE.
Is it harder to see prices then?
It used to be, but things like FINRA's trace system have brought a lot more transparency, reporting trade prices for many corporate bonds.
Got it. Now let's talk about tracking the market itself. Indexes like the S&P 500 or the Dow, what's their purpose?
An index is like a yardstick. It tracks the performance of a particular slice of the market. Large U.S. companies, small tech stocks, international bonds, whatever. It's usually a weighted average of the prices of the securities included in it.
Weighted. How does that work?
Most stock indexes, like the S&P 500, are market cap weighted.
Hmm.
Bigger companies have a bigger impact on the index's value. Some older indexes, like the Dow Jones Industrial Average, are price-weighted, where higher-priced stocks have more influence, which is less common now.
So how can an average investor use these indexes? That leads to index funds and ETFs, right?
Exactly. An index fund is a type of mutual fund designed simply to replicate the performance of a specific index. It buys the stocks or bonds in the index in the same proportions. Low cost, diversified.
And ETFs,
Yeah.
exchange-traded funds.
ETFs are similar. They often track an index too. But the big difference is they trade on stock exchanges throughout the day, just like individual stocks. You can buy or sell them anytime the market is open.
What are the advantages of ETFs?
Often lower expense ratios than traditional mutual funds, potential tax advantages because of how they're structured, and that intraday trading flexibility. You can even buy them on margin or sell them short, like stocks.
It feels like there are tons of ETFs now doing more than just tracking the S&P 500.
Oh, absolutely. You have strategic or smart beta ETFs that follow specific rules or factors like focusing on low volatility stocks, high dividend payers, or companies with strong momentum. They're trying to beat the basic market cap index or provide different risk exposure. Lots of innovation there.
Okay, so index funds and ETFs offer passive, diversified investing. What about traditional, actively managed mutual funds?
A mutual fund pools money from lots of investors. An active fund has a manager or team making decisions, buying and selling stocks or bonds, trying to beat a benchmark index, not just match it.
And they have specific goals.
Yes, outlined in the fund's prospectus, that's the detailed document. Objectives might be current income, long-term growth, a balance of both. The prospectus tells you the strategy, risks, fees, everything.
And there are many types of mutual funds.
A huge variety. Money market funds for safety, stock funds focusing on large companies, small companies, value stocks, growth stocks, bond funds, balanced funds mixing stocks and bonds, international funds investing overseas, global, regional, specific countries, specialty funds focusing on sectors like tech or healthcare. Lots of choice.
Fees seem like a big deal with mutual funds. Loads, 12b-1 fees? What are those?
Yeah, you have to watch the fees. Loads are sales charges. A front-end load is paid when you buy, a back-end load when you sell, sometimes declining over time. No-load funds don't have these direct sales charges.
And 12b-1?
12b-1 fees are ongoing operational fees taken out annually, partly used for marketing and distribution. All these fees loads, expense ratios, which include management fees and 12b-1 fees, reduce your actual return. So lower fees are generally better, all else being equal.
How do we judge how well a mutual fund is doing?
You look at its net asset value, or NAV, that's the per share value of its holdings. You look at its yield, the income it pays out. But the main thing is total return, which includes both NAV changes and any reinvested dividends or capital gains.
And compare it to?
Compared to its benchmark index and to similar funds, its peer group. And look at performance over the long term, 3, 5, 10 years, not just the last quarter. Consistency matters.
Okay, moving into more complex territory, derivatives. Options and futures. What's the basic idea behind derivatives?
A derivative is a contract whose value is derived from something else, an underlying asset like a stock, a commodity like oil, an interest rate, or an index.
And why use them?
2 main reasons. Hedging, managing risk, like a farmer using futures to lock in a price for their crops, and speculation betting on price movements, trying to profit from changes in the underlying asset's price.
Let's start with options, calls and puts.
A call option gives the buyer the right, but not the obligation, to buy the underlying asset at a set price, the strike price, before a certain date, the expiration date. You'd buy a call if you think the price will go up.
And a put.
A put option gives the buyer the right to sell at the strike price before expiration. You'd buy a put if you think the price will go down. Option buyers pay a premium for this right. Option sellers, writers, collect the premium, but take on the obligation if the option is exercised.
Okay. How do futures contracts differ?
Futures are more binding. A futures contract is an obligation for both buyer and seller. The buyer, long position, agrees to buy the asset at a set price on a future date. The seller, short position, agrees to sell it.
No choice like with options.
Nope, unless you offset your position before expiration by making an opposite trade. Futures are heavily used in commodities, oil, grain, metals, but also financial instruments like currencies and stock indexes for both hedging and speculating.
Seems like leverage could be involved.
Definitely. Both options and futures allow you to control a large amount of the underlying asset with a relatively small amount of capital, which magnifies both potential profits and potential losses that require careful understanding.
Right. Lastly, let's briefly touch on alternative investments. What falls into this bucket?
Alternatives are basically investments outside the traditional stocks, bonds, and cash. Things like hedge funds, private equity, venture capital, which we mentioned earlier, real estate, sometimes through REITs, real estate investment trusts, commodities, even collectibles.
And what makes them alternative?
Usually, they're less liquid, harder to buy and sell quickly. They might have higher minimum investment amounts, often less regulated than public markets. And they tend to have low correlation with traditional assets, which can be good for diversification, but they also come with unique risks and complexities, often for more sophisticated or institutional investors.
Wow. Okay, we have covered a ton of ground today, from how companies get funded to the rules of the road, and then this whole universe of investment products, stocks, bonds, funds, derivatives, alternatives.
Yeah, it's a lot, but hopefully connect some dots. The goal was really to give you that foundational understanding, that framework for seeing how these pieces fit together in the financial world.
It really is interconnected, isn't it? And constantly changing. Hopefully, this deep dive gives you, our listeners, a better base to explore further, to understand the news, and maybe think about your own financial journey.
Yeah, absolutely. It's about empowering you with knowledge.
So, as we wrap up, maybe a final thought to leave everyone with. Considering everything we've discussed, the global nature of markets, the complexity, the constant innovation,
Yeah.
what's maybe the one area you think is most vital for individual investors to really get a handle on today?
That's a tough one. Maybe. Understanding risk, not just volatility, but all its forms, market risk, credit risk, liquidity risk, and how different investments behave. And importantly, understanding your own tolerance for risk. That seems fundamental to navigating everything else.